Hey, good morning, everyone, and you're all welcome to our first Coffee Microcaps webinar of the year. A bit late getting started this year, but never fear, we have a plethora of webinars coming up over the next 2 weeks. Indeed, we've got 21 companies at this stage slated to present over the next couple of weeks. So while we might get out to a slow start, we're going to be getting up and running to top speed very quickly. I'm just going to run through a couple of our standard intro slides, and then we're going to get straight into it with our first presenter this morning. For anybody who is joining us for the first time, my name is Murtagh, and I'm the founder of Coffee Microcaps, and you're all very welcome to this morning's event. And new year, new sponsor. I'd like to welcome the team from DMX Asset Management, who are going to be our online event sponsor here for the whole of 2026. For anybody who's been around the microcap and indeed the small cap space more broadly in the ASX, the DMX team should be no stranger to anyone. And if you are looking to deploy capital into microcaps or small caps, please check out their relevant fund PDSs on their website, or indeed reach out to the team there at DMX to either Stephen or Michael. And as always, we welcome back our friends from ASIC if they're tuning into this morning. For anybody who's again joining us for the first time, the companies we tend to have on here capped under 300 million in revenue and approaching cash flow break even, or indeed as some of our companies are here this morning demonstrate how already profitable and dividend paying. We tend not to have companies from the resources and biotech sector, what I like to call industrial microcaps, which kind of encompasses all the other industry sectors. Structured this morning's webinar, we've got 3 of our 21 companies lined up presenting this morning. 30 minutes for each company, which will break down 20 minutes of Prezzo, 10 minutes of Q&A. If you do have any questions for any of the presenters, please type them in the Q&A box rather than the chat function. Just makes it easier for us to moderate the questions. The webinar is being recorded and it will be posted on the Coffee Microcaps YouTube channel on Monday. You can follow us pretty much on all the socials, LinkedIn, Twitter, YouTube, as I said, for this recording and all our other recordings. So if you miss anything over the next couple of weeks or you're looking to join some of the others while we're coming up, please check out our social media pages. And I do write a monthly newsletter, which you can get on Substack. Our 3 companies this morning, we have got Reckon coming back to give us an update. We've got the CEO Sam Allert joining us. Chris might be joining us, I think, maybe a little bit later. We'll see. Then we've got the team from Asset Vision again coming back to give us an update. Lucas, Murtagh, and Damian Smith. And then we are welcoming Andrew Ward from InvestSMART. InvestSMART haven't been here with us for, I think, 2 or 3 years, so it'll be good to get an update from them. But we will kick off now with our first presenter. I'm going to hand you over to Sam Allert, CEO of Reckon. Sam, I'm going to stop sharing my screen, and if I could ask you to please start sharing yours.
Excellent. How's that?
I can see the cover slide of your presentation now, Sam. You can take it away whenever you're ready.
Fantastic. Thanks very much, Mark, and congrats for all that you do with Coffee Microcaps. We're very pleased to be invited back and presenting to you and your audience. And thanks very much to everyone who's dialed in to listen to my update. Quick correction, you've only got me this morning, 20-minute update, so Chris can carry on doing his work, but it'll just be me providing the investor update. Very pleased to be sharing our full year results with you all this morning. We released these just under 2 weeks ago to the market, and obviously you've been doing a round of investor updates and broker presentations. Really important to know, we run in a calendar year, so these are a full 12 months year end, running to the end of December 2025. Before I jump into it, we're ecstatic with these results. It feels like a bit of a breakout year for us, particularly results-wise, but also executing on our business strategies, where we've got 2 businesses with very clear medium to long-term strategies. And we feel like we made tremendous progress on those strategies and delivered outstanding results, of which I'll get into the detail throughout. I'll just share our usual disclaimer there. At an extremely high level, for those who don't know Reckon, and I have got a bit of a history slide to share next, we are a technology company. We develop software in 2 regions, the primary one being in Australia and New Zealand, and also we've got a region or a business in the US. We develop our own software, we then sell and distribute that software, support the software, market that software, upgrade, etc. We've been listed for a long time and got a very, very solid, strong earnings profile. So in the full calendar year, we did 62 million of revenue, 26 million of EBITDA, and 7 million of NPAT. We've always been a dividend-paying company, and we do generate our own cash. So we're very pleased to again pay a fully franked 2.5-cent dividend in September last year, which is in the back end of our half-year results, but our first half is slightly stronger than the second half, so it makes sense to pay shareholders that full annual dividend around September. The third point there, we do carry a little bit of debt, primarily because of the fifth point there, that we did do an acquisition right at the start of last year, Cashflow Manager. So we did use a bit of our debt facility to buy that business. We paid 8.7 million for them, and they contributed tremendously to our results. I'll talk a little bit more about them shortly. And then in our 2 businesses, we saw 15% subscription revenue growth in our US-focused legal group, and 27% revenue growth in our own and cloud product for SMEs based in Australia and New Zealand. A little bit more about our sort of corporate registry. Yeah, as Mark said, we trade under the code RKN. We've got a very experienced board who also are shareholders in the business, and we're very pleased to be supported by some terrific funds. The 2 major ones there, Micro Equities and MA Financials, who both hold a very strong position in the company and very, very supportive to work with both of those funds over the years. I'm going to spend a bit of time on this slide, and it's just a bit of an investor history of Reckon, and I think it's very important for those who may have heard of Reckon, looked at us previously, maybe looking today, wondering why we're a bit smaller than we were, say, back in 2009. I just want to take you on our journey and then really lead into where the business is at today. So we founded in the late 80s. Greg Wilkinson founded the company, and at that time we were a distributor of software to small businesses and also individuals in Australia. Things were quite different back in the late 80s. Software was all about box software, where you went and bought from a retail store like Harvey Norman, Officeworks, etc. In 1994, we got the rights to distribute Intuit's QuickBooks throughout Australia. And that was a big change and a big step forward for the Reckon Group. In 1998, we took that distribution into New Zealand. And in 1999 was when we first listed on the ASX as a tech company, primarily distributing QuickBooks in Australia, but we also did have other smaller products and services like POS, etc., that we delivered companies. In 1999, moving into 2000, I think, whilst I haven't put it on the investor slide, it's important to remember that year 2000 was the invent of GST in Australia. So us and our biggest competitor at the time, MYOB, both saw a very big take-up of accounting software to help SMEs manage their GST. So we saw QuickBooks take off. And again, in those days, it was actually primarily sold via retail stores, Officeworks, Harvey Norman, etc. So we had some terrific years of growth from 1999 to 2004. This red line here from 2004 to 2009 was a really expansive era of acquisitions for the Reckon Group. It started in 2004, where Reckon acquired the APS practice management software, which was software for mid to large accounting firms. We then acquired Reckon Ltd in 2006, which was very similar, but was tax and compliance software for smaller accounting firms. We acquired Shellco, which gave us an intro into new company formation, and then Reckon from Esperon, which actually gave us Billback, but also complemented our new company formation. We then acquired Billback in the US and merged that with NQ, and that is our legal group that sits there today that I'm going to talk a little bit about further. So we went through an exciting period of growth via acquisition, and at that time we would have been in certainly in the top 300 ASX stocks. Then some big things happened. Primarily, and it's a really important point, that in 2012 and around this time, we were seeing the advent of cloud technology. We really wanted to own our own future. And so we stopped that distribution agreement with Intuit. We kept all of the clients, we kept 100% of the revenue and a right to use that software. But we had to drop the QuickBooks brand. So we renamed it Reckon Accounts and educated the market on that. And there was a limitation on it being able to sell their product, which is why we started working on our Reckon One application, which we then first released. If I jump to 2016, we first released Reckon One in 2016. Super quickly, because I'm conscious of time, we also acquired some document management businesses, one in the UK, one in the US, brought them into Australia. And around that time, we realized that the sum of the parts was greater than the whole. We weren't getting real value just as Reckon for all of the assets we owned. So we looked at opportunities. We demerged document management in 2017, and that listed and has probably gone 5 times for shareholders that stayed in there. We continued to invest in Reckon One and payroll and mobile apps for SMEs in Australia. We then acquired a complementary business in the US called ZebraWorks, which is the management team that runs our US business now. And then we did 2 other sales. We sold our Reckon business to Class Super for 13 million, and the year after we sold our accountants group for 100 million to the Access Group. I point out that sale because at the time of that sale, APS or the accountants group was about 30% of Reckon in terms of revenue. We were trading at about 90 million as a market cap, and we sold 30% of our business for 100 million and really rewarded shareholders who could see the value of the assets that we ran. We got very, very focused then on our remaining 2 businesses, which is all the way to where we started, accounting and payroll software for SMEs in Australia and New Zealand, and then legal software for legal firms in the US and the UK, complemented by ZebraWorks, and also the Billback business that we'd acquired in 2009. And then right at the end of 2024 and completed in January last year, we acquired Cashflow Manager, which is another accounting and payroll software business with just under 20,000 clients. Which brings us to today. So these are the 2 businesses. The businesses very much complement each other in the fact that we've got a highly profitable, lower growth business in Australia and New Zealand that we can use the cash flow out of this business to invest in a much higher growth opportunity. So a smaller part of our group at the moment, but a massive market in terms of growth opportunity. And so the businesses work really well in that regard. At the same time, it's important to know we've got a full management team in the US. So we've got 60 staff in the US, and they do run independently. So we run separate dev teams, management teams, sales teams, support teams. So the businesses can run and operate separately. I mentioned our results. I'll probably point you to the blue growth year on year at the bottom of our results. So for the full year, we did 62 million of revenue as a group, 26 million of EBITDA, which was up 30%, 7 million of NPAT, which was up 94%. In the year as well, we continue to invest in our products, 15 million invested into development. And as I mentioned, because of our strong financial position and cash generation, we've always been a dividend-paying company, and we paid a 2.5 fully franked dividend in September last year. So in a very quick intro, I've summarized our history, the group, where we are, and the group financial results. I'm now going to deep dive into both businesses, starting with the business group in Australia and New Zealand, and then the legal group. And then, as Mark said in the intro, we'll leave plenty of time for Q&A after that. So for our business group, for those who aren't aware, and again, bearing in mind, we've delivered accounting and payroll software in this market since 1994. So over 30 years, we've been delivering these compliance tools for SMEs in Australia. We've gone through everything from desktop software to cloud technology and now into the advent of AI. We've gone through every possible compliance change the ATO can do, from GST to single touch payroll 1 and 2, e-invoicing, and now Payday Super coming up. And what you'll see in the red bar, our focus has been to grow our cloud revenue each year. I'm very pleased to finish at the full year 2025 with 27.5 million of cloud revenue. Now, our cloud revenue does include both our Reckon Accounts Hosted and Reckon One product, and I think it's important to share that. So Reckon Accounts Hosted and Reckon Accounts does leverage the old Intuit code base. So we've got a lot of clients who are very, very happy on that code base, and we've generated a lot of revenue and a lot of cash flow from maintaining that product and updating it and ensuring it's compliant. But our whole strategy has been to build out our own IP, our own cloud product, Reckon One and mobile apps, own our future, and deliver a far slicker and better UX product, not only to our existing clients, but something that can grow rapidly. The blue numbers are paid subscribers for each of our product lines, and you'll see that majority of our paid subscribers already are in Reckon One. They would be new subscribers largely coming into the business, because as we've been developing the features of Reckon One, we've been selling it to new SMEs and getting new growth. We have started our transition from the left to the right. We haven't yet forced any client to upgrade from our older products to our newer products, but that is absolutely the plan over the coming years. We will get terrific efficiencies by having everyone in our business on the one platform, not only from a development perspective, but from a sales, renewal perspective, support perspective. And we do get some real operating leverage because the Reckon One infrastructure is a true cloud infrastructure and actually would get some COGS savings. I mentioned the acquisition of Cashflow Manager. So you would see Cashflow Manager, 19,000 clients, exactly like our own Reckon Accounts products. We acquired that business with a view to bring them into the business group, or into the Reckon One business. It has been a terrific acquisition. So we paid 8.7 million for the business. And in the full year, Cashflow Manager delivered just over 6 million of revenue, 3.3 million in EBITDA, and 1.6 in NPAT. We always knew they were going to contribute well to our financials, and it has been a terrific full year contribution. Probably more excitingly has been the quality of not only the client base and their happiness with the product, but their interest in moving to the cloud, but the quality of the team. We've picked up, albeit we did have to cut some heads during the acquisition, we've picked up 20 terrific team members, and all of them have lent into Reckon. And we've now got the Cashflow Manager development team working on our Reckon One product, the sales team selling our Reckon One product, and we're very, very pleased with that acquisition. We always share some case studies, but I'll let you read those after in the interest of time. And these are the financials for the business group. And I really want to just point out the total revenue in the blue bar, up 16%. We have now broken out each of our product lines as individual revenue lines, and you'll see where we're getting all of our revenue growth is in Reckon One. And simply put, what you want to track is all of these other lines, desktop and hosted and even Cashflow Manager, over the next couple of years rolling into that Reckon One revenue line. It's a terrifically profitable business. So of the 48 million of revenue, 25 million of EBITDA, and we invest 9.9 into development. So there's 15 million of free cash flow coming via this business. In the last couple of minutes, I want to importantly jump into our US-based legal group. As mentioned, we've owned a business in the US since 2009 when we acquired Billback and NQ, and it's contributed circa 8 million of revenue each year over that time. And it was 4 years ago where we met a startup business called ZebraWorks. We acquired that business and brought them in to merge with our US business, but really lead our strategy in the US and the UK. Point 4 there is really, really important. Bill Bice, who came with that acquisition, and his management team are very, very experienced software builders and business exiters. So Bill wrote ProLaw and sold that to Thomson Reuters. ProLaw is one of the largest practice management software for legal firms in the US, and he sold that to Thomson Reuters well over 15 years ago in a terrifically successful transaction. His team then ran the legal division of Thomson Reuters before going and doing other projects. It's that team that got together to start ZebraWorks, and they saw a real opportunity to innovate with today's cloud technology and really advance and leverage their knowledge and expertise to deliver workflow solutions, billing automation, payments and collections for mid to large legal firms. The last 2 slides that I'll cover on the legal group. These are the products we deliver. The document workflows where we help firms with scan management, print management, secure print release, and cost recovery is the larger part of our revenue, because that's what we've owned for a long time. But the exciting part is the billing queue workflows, where we're helping with the billing automation, the collections, and the payments. And we're now up to 1.5 million ARR. That's 100% growth. And this chart is the one that gets investors excited. So the blue line is the amount of attorneys we've sold to. The red line is the amount of attorneys we've installed, which represents the 1.4 as recognized revenue. We've sold to 5,000 attorneys in a market that has a TAM of 1.1 million attorneys. So we're super excited about the growth potential of this business. And the last slide, Mark, just to highlight the financial position of the legal group. So we saw 12% revenue growth, but 111% growth in our new cloud products. And then we did see them start to contribute terrifically to an EBITDA performance. We still invest in the product. So it's great to see the EBITDA performance, but they are still costing us about 1.6 in free cash flow. And the view with this business is that by the end of this year, just by pure revenue growth, we will be generating cash out of our US business, which again massively complements the great cash we generate out of the Australian business. That's my summary. I'm conscious you've jumped back on, Mark, but just to say we feel like we're in a very strong position. We're very experienced, not only in Australia with SME software, but also in the US with legal tech software. We've got very, very clear strategies, and complemented by Cashflow Manager, it feels like a bit of a breakout year in terms of terrific top line growth, EBITDA growth, and impact growth as we continue to execute on those strategies. Mark, I'll jump over there to you for Q&A.
Yes, thanks, Sam. Yeah, we've got a couple of questions that came in there just while you were presenting. The first one I'm going to read kind of word for word. Can you explain the complexity of transitioning the Intuit source Reckon subscribers to Reckon One? And can you accelerate this transition by, putting a sunset on, I know you said you haven't forced people to move over, but, how long of a tail will that kind of transition take? If you've got any thoughts on it.
It's a terrific question and one we get asked often. It's the exact right question, by the way. The biggest restriction or thing we've been working on is features in Reckon One. And if I go back, because we distributed Intuit's QuickBooks product, Intuit had invested not millions, but billions into the feature set of that product. So our Reckon Accounts desktop product and Reckon Accounts hosted has features that Xero doesn't have today, for example. So when we started building Reckon One from scratch, we not only wanted to make it a better UX and better tech stack, but we had to make it feature parity to Reckon Accounts and Reckon Accounts hosted. We are there. Today, we know that we could migrate 70 to 75% of our user base based on features. That's why we're ready to accelerate the migration. By the end of this calendar year, based on our planned roadmap, we know that we'll be able to migrate 90% of those clients purely based on features. That's been the slight delay in the acceleration. We've now dealt with that from a pure feature set. We're now very much into the process of migration functionality, the migration tool, the process of hand-holding clients through the migration. We've commenced it. We're already migrating at least 100 to 150 clients every month. But the second part of that question, will we accelerate it? Yes. 2026 is the first year we're really going to accelerate it. At the back end of this year, we'll look to end of life SKUs, some of the older products, and that will roll into an even bigger year of migrations in 2027 with a potential tail in 2028.
The questions are flying in here, but I'm going to group kind of three AI questions in together. One, and broadly, it's kind of, we were chatting offline before we started, the risks and the benefits of AI. So, one question is around AI internal tools being a threat to the legal business and stuff we've seen about, coming from Claude and just even in the recent week. But then, as we were talking, I'm sure people saw the premium announcement earlier in the week. AI dev tools, to like massively reduce your cost base or enhance, the work that the development guys can do on Reckon One. To your point, you were just talking about, to help the migration move faster. So maybe just costs and benefits for AI across the Reckon group, we'll say, accounts and the legal business.
Yeah, another great question. And we'll probably need to take the full half an hour of the next presentation to answer this if we can, Mark. But no, I'll do it super quick because look, let's start with the positive. We are really leaning into AI, obviously in development, but over all aspects of the business. The three areas we're getting the largest leverage of AI now, and we have invested heavily, is across development, marketing, and support tools. If we pick development only, we're getting a 20% efficiency gain from our team using AI tools that come embedded with all of the Atlassian and other development tools and coding tools that we use. What Mark and I were talking about offline is thankfully we already generate a lot of cash. So we're not looking to use that 20% to get pure cost savings at this stage. That's obviously an opportunity in the future. We're using that 20% to move on our strategies faster, release more features in both Reckon One and the legal tech software, 20% faster than we were 18 months ago. And we think we can probably double that efficiency over the next 12 months with further investment and training of AI. Big believers in the efficiency gains, big believers in adopting it. And again, they're the three key areas we get it: development, marketing, and support. But we actually see AI improving all aspects of our business. In terms of the risks, it'd be folly to say that there's no risk. I think that any software company is watching the risks. We've particularly got questions about the risks in our new cloud products in the legal software. Chris and I have been attending big conferences over in the US for a number of years now. AI has kind of gone from 5% of the agenda 3 years ago to 99% of the agenda today. And what legal firms and legal tech companies are battling with is they're all leaning into AI and see its advantages, but they're all grappling with the fact that AI and machine learning algorithms are as powerful as the data that is fed into it. Legal firms deal with highly regulated and highly private and confidential data. Even in a mid-tier legal firm, there's certain clients, there's certain partners that can't share work with other partners. So it's not as simple as running AI over a legal firm's database. We see the same in Australia. People talk about, well, could someone build accounting software? Sure, someone could go and use an AI tool to code fast and build an accounting software. One, they've got to go and distribute that software and migrate from us and other competitors. But the two biggest providers of data we work with in Australia, one are the banks. So we've got direct feeds coming out of the banking ecosystem. They're not going to open that infrastructure to open AI that's not locked down and very secure. And the other organisation we work with is the ATO. And the government is very, very strict on the privacy and data regulation and security in terms of us pushing or receiving any data about an individual, a tax position, etc., with the ATO. So whilst we're using AI to drive massive efficiencies, we think it's way too early. We'll continue to monitor the risk, but we don't see any short-term risk of Claude or someone coding a product that can do what our teams can do, because we've already got through the data privacy and have access via secure mechanisms to those data pools.
One quick one, because we're not going to get through all these questions we have for Sam, but Sam, I will send you these questions and maybe you can reply to the people where we have contact details. Payday Super, obviously coming up 1st of July, if we don't get a late postponement, which I've seen in the media might still happen, but at this stage it's still going ahead according to the ATO and the Treasurer. That functionality in the old Intuit code, have you guys had to add that in, or can you use that as I'll say a sweetener to move over to Reckon One, as a way to kind of get people to do stuff, because the change to Payday Super is massively impacting loads of systems, from accounting to HR to onboarding, everything.
I love it. Love that question as well. Thank you, whoever asked that. Yes, we are using it as a real incentive for people to upgrade from older legacy products to the newer ones. Simply put, our Reckon One, Reckon Payroll product has automated Payday Super compliance today for free, and push button, and we work with a partner called Beam, and super funds will be paid. And that's all that the client has to do. Of course, we service 60,000 odd clients on our older products, so we can't not let them comply. And we would always continue to service them, and they've been very supportive of us. So we will be Payday Super compliant in each of our desktop products. However, the process will require some manual steps from our clients. It's actually what they're doing now to pay their super anyway. It's just that they don't have to pay it as often at the moment. So we will be Payday Super compliant, but it will have some manual steps, whereas the Reckon One payroll will be fully automated and for free as part of Reckon Payroll.
Yeah, Sam, we're going to have to leave it there, unfortunately. Thank you very much for coming back and giving us an update. And apologies to anybody if I didn't get to your question. We were just swamped with questions there in the time that we had. And I will hand over now to the team from Asset Vision. I see they have joined us there in the background and been waiting patient, Damian and Lucas. I'm not sure which one of you guys is sharing the presentation.
Yeah, I'm going to have a crack, Mark, of sharing my screen. So give me 2 seconds.
I will let you know once it's up here, Lucas. Yeah, I can see it loading now. For the cover slide to come through.
Looks good at my end.
Yeah, if you want to just go, yes, there we go. You can take it away, Lucas, whenever you're ready.
Beautiful. Thanks for having us, Mark. I can't believe it's 12 months since we were last on Coffee Microcaps. But look, we've had a great year. It's been an exciting year, and I think Damian and I have had a bit of fun and a little bit of success at the helm of the company, which has been great. Damian's here as well. G'day, Damian.
G'day. Hey, Mark. Hey, everybody.
Welcome, gents.
Look, hello to everyone that's joined us. A shout out to the sponsor, DMX Capital, one of our shareholders. So thanks for all your support. And I know there's a few people out there that have been following us for a while that are joining in today. So g'day to everyone that's out there. As we said, we've had a great start to the year. Our ARR has kicked on. We've been winning lots of new logos and getting a lot of expansion revenue from our existing customers. I think the most important thing is we've been doing this while still putting cash in the bank. And as you see on the screen there, our rule of 40 is at 55, which means we're growing, but we're also generating cash. From when we were here 12 months ago, our cash in the bank has gone from under $1 million to over 2.2 million in the bank. So we're in a position now where we can self-fund and invest in our growth, and we'll talk a little bit about that later on in the presentation. Damian, I might let you talk to some of the product highlights.
Yeah, sure. Look, I mean, the product's always growing. We're always evolving it. We're always building new features, especially to support our existing clients, but I guess also to attract new clients. And so a big theme for last year was around asset financials, asset valuations, and putting that functionality in over the course of last year. It enabled us to win half a dozen councils and a water utility as well. So yeah, it was definitely worth doing. And our team also grew by 2 FTEs. So we have a new client delivery manager now who's going to help us roll out Asset Vision into our growing client base, and a brand and marketing manager, and we'll probably touch on brand a bit later.
So just to go through our financials, so look at the top line, ARR is now at 5.2, and we'll go into it a bit later, but our pipeline is in a really good position. So we expect that ARR to continue growing, and our cash at bank is in a really healthy position. I suppose the key thing from this slide, where we've had the most questions, is the increase in FTE costs. There's a couple of things there. So the first thing is the accrual of bonuses. So last year we didn't accrue bonuses until the second half. So there's about 187,000 in this year's cost that wasn't there last year, but we ended up having that amount there. So if you really look at it at a face-on perspective, it's only a 22% increase in FTE costs. And that extra increase is coming from those 2 roles that Damian just spoke about. But also we've aligned all of our staff salaries to industry benchmarks. So we've got a really aligned workforce now with regards to remuneration. From a market information point of view, this year I think our share price was the same when we presented this time last year as it is today. From a shareholder point of view, we're in a pretty similar position. So MA Financial and Salter Brothers are still some of our largest institutional shareholders, and the top 20 and board of management shareholding hasn't really changed over the last 12 months. Our board, again, we've got a lot of stability in our board. Luke and Peter bring a heap to our board. Luke from a government perspective, he's got a great network, and Peter from a commercial perspective, working with Downer and Ventia, he's got a great understanding of the industry that we play in. And of course, Vezin is our CFO and company secretary. We've done some great work. We've got our results out very early this year, and that's testament to the work that Vesna and her team are doing in the finance department. So I suppose we'll talk about our vision and purpose, and I'll talk to the vision. I'll let Damian talk to the purpose. But we've been able to really achieve a lot in Australia over the last 12 months in enterprise asset management. Our platform's growing in all our key industries, so transport and local government and ports and facilities. And we think we've got a product now that we can take to the global stage. So we have updated our vision to become a global SaaS leader in enterprise asset management. We think, and you'll see it later in our strategy slides, that we're in a position to take the company not only to other states in Australia, but overseas. So increasing that market opportunity.
Yeah, I think the key for our purpose, I suppose, and it kind of carries from our vision to purpose is we are making things easy for our clients. They operate in a very complicated, multiple work teams. They're managing critical infrastructure, and there's a lot of communication that needs to happen. And so we're taking something that's quite complex, like enterprise asset management, and really trying to make it as easy and more collaborative as possible for them. And as a result, I suppose we find that our clients love to use our platform, and they turn into big supporters, great reference sites, and it really ends up, I suppose, it provides a great positive foundation for us to work together, which is probably a great segue into this slide. So look, I guess when the platform started or the business started a long time ago, we were really focused on maintenance teams, maintenance workers, asset inspectors. And we did that for a number of years, particularly in transport. We did it really well. We focused on it. We worked with guys out in the field, and we made sure everything was working perfectly. And so naturally, after some time, we look for opportunity in other work teams inside those clients, and they also pull us into those other work teams as well because they wanted the same kind of benefits that they've seen. So, and it's quite typical for organizations to have different systems in place for all these different areas, and it's really hard to share data between themselves, let alone other companies and in that chain. And so we've basically, organically, I suppose, worked our way into these other areas of the asset life cycle, these other teams, and it's been great to give them the same kind of productivity benefits, get them off paper, help with their processes, and collect all that really important data. But I suppose as a side benefit, all that data is now centralized, and it's all captured, and we can look at the next phase to help them holistically, which is trying to help them make better decisions because they've got more data. So that's ultimately where our path is starting to take us.
Now, these are the verticals we play in, and those who have been following us will notice a subtle difference here. When we presented last year, there was ports and facilities on this slide. Ports has been moved into transport. Civic and community was just local government last year. We've now extended that. We're doing a number of community sites, and they may be housing developments, example like Hope Island community or Martha Cove community. We're also now rolling out in South Bank in Brisbane. So that vertical has grown. We've seen the most growth in local government. Damian mentioned the 6 councils we've won in the last 6 months, but we've won a dozen in the last 9 months. So we've got really, really strong momentum in the local government space. A really important win was in the utility space for us this half, and that was Western Port Water. So that's our first water utility where we're talking about supporting drinking water and sewage treatment plants, that critical infrastructure that helps our community every day. And I suppose the new one on this slide is social infrastructure. So it's something that we're seeing a lot of demand for in our pipeline. So we're talking things like hospitals, universities, schools, public housing, and aged care. So we're seeing quite a lot of growth in our pipeline in that vertical. So it's been a subtle change, but an important change for us over the last 6 months. From a customer point of view, we keep looking back at this slide from previous years, and the number of logos on this slide continues to grow. And they're not just small logos; they're large state government departments. They are councils across all of Australia. We've won in Victoria, in Tasmania, South Australia, Western Australia. We're getting really good breadth of sales across Australia now. And then we're also working with large maintainers that support asset owners from a maintenance point of view and an asset management point of view. So I'm talking the likes of Ventia and Downer and Service Stream, Athiona, that have all come on and continue to support their asset owners using our platform. I think what we've become really good at Asset Vision from a board point of view is actually each year setting clear priorities. And we've done this for the last 3 years. And I think if there's anyone out there that's followed the story, we stick to these priorities pretty clear. And it's the reason we've achieved the success we have, going from a company 2.5 years ago, which was cash flow negative and not much cash in the bank, to a company today that's got a solid cash balance, cash flow positive, and growing revenue. So I think the first of these, Damian, is product.
Yeah. So it's good to kind of show what we do here on a screen, I suppose. Like we're obviously always busy, we're always building, but these areas are where you could break up our time into. So the core platform being all the day-to-day tools and things that that our clients are using, and we're always iterating and adding features. And when Asset Vision's a part of a bigger system, we integrate into other pieces of tech, like SAP, for example. And so we've got to maintain that integration layer as well. And of course, as our core platform's growing, we've got to make sure that we're, catching up with those integrations as well and not letting them get left behind. And the tech stack, it underpins everything that we have. So whether it's from Google or Apple or Microsoft, we're building on their foundations. And as our platform grows, we really need to be mindful of the tech stack that we're building on. And so we spent a lot of time proactively in that space. Last year we totally redid our Android and iOS apps as well, because the technology is moving so fast. And innovation is I guess that experimental, that sort of fun stuff where we can fail but also succeed and catch lightning in a bottle. And so something here like autopilot, for example, came out of that innovation stream. So this is essentially how we use AI for our clients. Their road inspectors can drive along, and our app there that you can see mounted, it captures the images of the road. We do things with those images like look for defects, find the potholes and cracks and all those sorts of things, and they get tipped back into the maintenance workflow and the planning side of things. And we also do other cool things like show a top-down view so they can see things slightly differently. And Rewind's been really good for us as well, which is essentially enabling them to take a current location, which shows a current condition of a road, and sort of wind backwards and see what it used to look like over time. So it's sort of helping them get insights into how things look out there, but also helps with claims and natural disaster insurance and all those sorts of things.
Thanks, Damian. I think it's important to note with our autopilot product, it's currently being trialled across 3 large state government departments, and is also in use by a number of our contractors working with asset owners right across Australia. So it's something that we've created from scratch. It's out there now in the market, and people are paying for it, which is pretty exciting to go through that whole birth of a product idea right through the deployment out into the field. AR growth is going to be a lot what we're about over the next couple of years. The last 6 months, there's new logos coming on board, and our pipeline is as strong as it's ever been. So we expect to see that growth continue into the second half, and we're excited to bring on new clients in the second half. And I know coming with this, Damian's team is busy delivering a lot of this work now for these new customers that are coming on. So that adds to our service revenue going forward as well.
Yeah, we mentioned earlier that we hired a brand and marketing manager as part of our this priority to strengthen our brand. So it's been really great to refresh our visuals, our marketing collateral. You'll see us a lot more on LinkedIn now, and I suppose the biggest thing for us has been, well, for me at least, is that we're now communicating more with the world about what we're doing. We've got case studies. We're telling people when we win a client. So it's just it's been really good to be active, and so I guess as a part of all of those pieces, it's definitely made a real tangible impact, as we've seen. I think 5 times growth in inbound leads as well, coming from all those places. So yeah, it's going really well so far.
One of the priorities we set out the study was to benchmark our performance from a SaaS point of view. And I think, speaking to a lot of analysts out there, they've really loved this slide. It's a really honest view of where we are as a business. You look at the red bits, we always start with the bad bits, but from a scale perspective, we're still small, we're still subscale, and we know that, but we're driving our growth as hard as we can to get to a point where we're not subscale anymore. And from a customer concentration point of view, I suppose if you look at that, our top 10 is makes up 65% of our revenue. But if you look back 3 years ago, that top 10 would have made up 99% of our revenue. So, that number's actively coming down. If you look at the amber metrics there, I think we're comfortable with most of those where they are at the moment. With scale, our recurring revenue will grow. Our cash EBITDA margin, we plan on keeping it at about that rate moving forward. So we're growing revenue, we're reinvesting, but we're still putting a little bit of cash away all the time. I suppose the one that we'll concentrate a little bit more on over the next 12 months is net retention. So we'll get better at managing our existing clients and growing revenue within those clients. But we've got some really good metrics there. The magic number, which is, for every dollar of sales and marketing spend, how much ARR do we expect to earn? So we're at 1 to 1.54. So essentially, if we spend another $1 million on sales, we should see another $1.54 million in ARR. Another way we're driving sales is through strategic partnerships, and Murtagh's an example of that. If you look at the last dozen local government deals we've won, they've all been in partnership with Murtagh, who provides strategic asset management. So the two platforms together, Asset Vision brings operational management, Murtagh brings strategic asset management, and it gives the customer a complete end-to-end solution and meets all of their needs, not just operational out in the field and from an asset management point of view, but from a long-term planning, from a financial, so from the CFO and the CEO point of view. So it's been a really important partnership, and we look forward to continuing that partnership with Ashay, Joel, and the team at Murtagh. But there's more and more coming, and the more and more our name gets out there, the more and more good work we deliver to clients. We're seeing tier one global partners coming to us to want to partner and include us as part of much bigger solutions. So that's testament to our brand and our delivery and our team over the last 12 months that we're starting to see those opportunities present themselves.
Yeah, so I guess, look, this is our recent Christmas party in Melbourne CBD, and it's getting hard to get a photo that includes everyone, but this is the majority of our team. We, as Lucas mentioned before, the last 12 months we've put in place, I think you mentioned before, STI and LTI program for staff. We've aligned salaries to market, but we've also established a values program, and they're sort of and you can see them along the bottom there, but it really is there to drive how we behave and communicate with each other, our customers, and our shareholders.
I think one point to add there, it's another year of 100% retention of staff.
Yes.
So that's 2 years in a row where we've still got that stability in the team, which is fantastic.
Mm.
The last priority was about strategic acquisitions. We've probably spoken to a dozen companies over the past 9 months. I suppose what you see there is the process we go through. We're going to be really diligent when it comes to acquisitions. We're not going to just do one because we've put it up there as a priority. We're going to wait and find the right acquisition. So that's really, really important for us. Yeah, I think that's the key message. We're going to be really diligent. So don't expect anything soon, I would say, is the message. Looking forward, so today it's all about our core, and our core is transport and local government. And we think we've got the best product, not only locally, but globally in those verticals. And we're going to go pretty hard at those industries now. So I think the key thing there is our sales and marketing as a percentage of revenue. Over the next 12 to 18 months, we'll put another $1 million into sales and marketing to drive that growth through the momentum we've got in those industries currently. Moving into FY27 and FY28, you saw those new verticals on the slide before. As we deliver Rouse, as we deliver Western Port Water, we'll put more and more sales and marketing activity into those industries that'll come with strong customer references. And there, look, in Horizon 3, we're already starting to work on the global piece. We're working with trade commissioners here in Australia to work out how we can effectively take our product globally. So just summing up, we're a proven EAM SaaS platform. The opportunity is huge in front of us. EAM is a massive industry and it's growing. Critical infrastructure providers have to do asset management better and stay compliant, and they need platforms like Asset Vision to do that. You've seen our SaaS economics. We know where we are today, and we're going to continue working on improving those, and we're going to support our team and keep that consistency, and we just keep having fun. And that's about it for today, Mark.
Thanks, Lucas and Damian. We've got a couple of questions that come in from the audience. So I'm just going to work through these. One probably for your CFO, and I will compliment her as well, saying it's great to see a lot of microcap companies, yourselves, Reckon the tree on here this morning, and a few others, getting results out early. I think it helps to, improve the sector and definitely sets the companies who get out early apart from the broader mix of microcap companies. Development costs. Are all development costs and software expensed to the P&L in the year, or is there any capitalization going on? I think just by looking at that amortization figure that didn't really change period over period, it seems like it's all expensed.
Yeah, we're a pretty simple business, Mark. Revenue minus expenses generally ends up in the bank. So everything's expensed.
Okay, perfect. Then on the AIR growth, a question around that of, how repeatable is the current pipeline across councils, utilities, infrastructure? It's been a very good run. I think the question is, how repeatable is, repeating that now that I guess the base is getting bigger, I think maybe.
Yeah, so there's more verticals that we operate in. Our pipeline is definitely as healthy as it's ever been. More and more local governments, more and more state government departments are coming to market for solutions in this space. It's driven by, they need to make better decisions around their assets. They've got less money to spend. So where every dollar spent is scrutinized. And if they don't have the data to support that, they're not going to get funding to go out and improve their asset base. So we're seeing, a great demand for the enterprise asset management space and our product.
Yeah. And in terms of geographic spread, I know you guys are based down there in Melbourne, and I'm sure there's a lot of Melbourne and Victoria councils. But in terms of across, is there states that are particular focus or are a bit more tech savvy and very keen to engage versus other ones? Maybe just give us where that pipeline or where you're picking up wins. Is it home state Victoria? Is it Queensland? Is it WA?
Yeah, the short answer is it's right across Australia. Government, it's like contagion. You win a customer in a particular area, and then you win the customer next to them, and then from there they talk to the council next to them. So we'll have to put a map in the next results presentation to actually show how that's actually worked for us. Look, in Victoria, it started to really get contagion, and now it's jumping over the Murray River. South Australia and Western Australia are the same, and now we're starting to see that in metropolitan New South Wales as well. So it's one of those things. You do a great job, you deliver a great product, and you get customer references, and that's what really drives ARR growth for us.
Can you quantify new business pipeline? How much ARR can you add in the next 1 or 2 years?
We can quantify it, but we'll probably put a statement out about that in a subsequent update. But we'll continue to try and beat the benchmark that we've got in the benchmark slide when it comes to ARR growth. So I suppose that's probably what we're trying to do as a business, is just continue to beat the benchmark.
And another one here. Biggest growth opportunity? I mean, is it deeper penetration into the core verticals, or expanding into the emerging two verticals, utilities and social infrastructure?
I think we've got 16 or so councils at the moment. There's 500 in Australia. That's our biggest growth opportunity right now. We've got momentum, we've got a product market fit, and we're just going to go really hard at that vertical.
Just on the social infrastructure one, is that also a bit of the contagion effect, where councils, so it's like public schools, state education departments, is kind of word filtering out, and now it's, local health centres, the schools, it's not directly under kind of a council purview, but obviously all of these government employees talk to each other, network with each other. Is it kind of filtering out from there, do you think, or have you got, have you actually made a concerted push into that space?
No, you're spot on. So what's driven it? We've actually had government departments in that vertical reach out to us and asked us to bid on tenders. So we weren't actually looking for it. It's come to us. So you're spot on. So just the good word, the good work we're doing out there is driving these inbound leads that weren't there 2 years ago.
And then, yeah, kind of maybe one for Damian on the implementation. I kind of referenced in another question. They reach out to you. You say, yeah, we've got a solution for you. But, you know, how are they being tech savvy enough to actually implement it then at kind of, you know, the speed that you want? Is there a lot of hand holding that goes on, or have you been kind of surprised at how, you know, up to speed they are and how, I guess, streamlined a lot of the deployments can be?
Yeah, it definitely varies from client to client. There's a mix, but I've been doing this a long time, and I sort of started with road workers that some didn't even finish high school. So, you know, we had to make things really easy to use, really easy to understand. And that sort of carried through to our, I guess, the people that we hire, the culture of the company. And so there, you know, whether we are hand holding or not, I suppose it's sort of it's part of our DNA to make things easy. So I don't really think about it too much. I mean, suddenly sometimes things do get dragged out, and there's things that we can't control, like they've got to spend a bit of time getting their data right, and we can help them as much as we can. But sometimes things just have to run its course on the client side. But in terms of delivering the solution, we spend a lot of time with them we spend all our time with them from the early stage through to go live and beyond. So by the time they're even training, they fully understand what they're getting into, and the way that we configure the system, it's around how they want to do business and do their operations versus having to get them to adapt how our technology works. So we sort of, you know, bend the system to suit them, and that keeps it really nice and natural for them to pick up, and including things like putting things in their own terminology and the way that they like to read certain things in the system. So we do a lot to make it easy. In the end, that when you look at the system, you know, it does look easy, but there's a lot of complication going on behind the scenes to make it look that easy. And so, yeah, that sort of carries through in the code and the technology, but also our people and the work they do behind the scenes.
The
Mark, just a quick
age-old
one just to
adage.
add on that.
And sorry, go ahead,
Just a
Lucas.
quick one to add, just from a contract perspective with delivery and when does ARR start? So our contracts are generally quite long. So anywhere from 5 to 9 years is a standard contract for Asset Vision now. And when we sign a contract with the customer, it doesn't matter when the project goes live, the ARR starts from day one. I think that's just an important point to note.
Yeah. My point on Damian's thing is people do things, you know, 2 + 3 is 5 and 3 + 2 is also 5. But you know, it's some people just like to look at it in a different way. Gentlemen, we leave it there. Thank you so much for coming back and giving us an update. Hopefully, it won't be as long before you can give us another one. And I look forward to the geographic map in the next deck when it comes out.
Perfect. Thanks,
Awesome.
Mark.
Thanks,
Okay,
Mark.
thanks, Lucas.
Thanks,
Thanks, Damian. And
Cheers.
I know our final presenter, Andrew Ward from InvestSMART, has been waiting very, very patiently in the background there. Andrew, if you want to start sharing your screen, I will let you know once it's come through. There he is there.
Hi, Mark. How are you?
Very good.
Good, mate. Good.
Very on brand
Right.
in his InvestSMART green polo shirt here today.
Thank you. You're very kind. Right. I'll get into the presentation then. Mark, can you see that on your screen?
Not yet. Might be just loading. Hold on. Yes, it's loading now, Andrew. Just give it a second there. Yeah, I can see the cover slide of your presentation now, Andrew.
Great. Fantastic. So InvestSMART's vision is to help all Australians grow and protect their wealth. We do that through having online content, some online tools, including research and advice, and we wrap that up into some affordable products. we've been acknowledged for our products by Finder in 2024 as most trusted robo advisor, and loved, and they complemented our service. So what I've done over here is I'm just sort of in the first point over here is I've broken down really what our funnel is in terms of generating fee-paying clients. So the front of our products is our website. So InvestSMART was founded in 1999 by Ron Hodge, who's our current CEO, and Nigel Poole, who's our current CTO. And from the beginning, their core strength has been online distribution of financial products. So at the moment, we sit at about 13.5 million page views during calendar year 2025. Out of those page views, we generated 24,000 new free users during 2025. And we have currently 21,000 fee-paying accounts, and that's across our funds management products, our subscriptions to newsletters, and insurance products. So our primary financial goal for monetizing this online distribution strategy is to grow funds under management. And our funds under management at 31 December was 2025. And those are all in our own products. It's important to note that we are a responsible entity. Also, we have a responsible entity license, and those are our own products. So the three core products are the InvestSMART professionally managed accounts. That's the robo advice offering, and we utilize portfolios of ETFs for that product. Then we have the intelligent investor managed funds. So those are ASX listed active ETFs. So there is an income portfolio, an ethical portfolio, growth, and an international portfolio. We think that for those types of portfolios, the best way or the best platform for those to sit on is the ASX to allow our clients to buy and sell. And they are open-ended funds, which means that those funds can be bought at their net asset value at any point in time. They're not a LIC. Then we have our subscriptions products, which is premium paid content through Intelligent Investor. Intelligent Investor has been around since 1998, and they began life as a newsletter for Australian for recommending buy, hold, and sell recommendations for Australian equities. We've also expanded that to international equities about 3 years ago. And on top of that, we also have market commentary and insights, which is headed up by Alan Kohler. He started Eureka Report in 2005, and he is a well-known voice. So we've got a low cost of customer acquisition, primarily due to the content that has been generated. And the reason I mention the length of time that we've had these businesses have been online for is that it creates a long tail for search engine optimization. So all the content that is trusted, that is in the ether, allows us to feature prominently on the front of web pages, which creates a low cost of customer acquisition for us. On top of that, our board and ambassadors are very well recognized. Paul Clitheroe started IPAC. He's our chairman. He sold it to AMP AXA, and he worked for Money Magazine and on Channel 9. So he has this very strong background in advice and media. Effie Zars is one of the younger members of our board. She's currently money editor for Channel 9. And the third non-executive member of our board is Michael Shepherd. He is more the finance and market microstructure expert to really give us a well-rounded board. He sat on the board for ASX for a long period of time. Alan Kohler isn't on the board, but he is our editor in chief and a great ambassador for us, on top of the content that he delivers for us. On this slide, this is more a sort of a visual illustration of the ecosystem or platform that we've created. You'll see in the middle band over there the content and tools ecosystem, the subscriptions, which is stock recommendations, markets, and economics. That provides revenue for us in terms of annual subscriptions, but also gives us that long tail SEO. On top of that, we've got a number of tools such as Bootcamp for beginner investors. And on top of that, the monetization strategy is through our own portfolios for InvestSMART. And we have also developed a white label solution, which I'll come to in a little bit when I talk about our funds under management. Moving on, this is more of a representation of. So sorry, these slides that are in the pack today, they were released to the ASX when we released our half-year results on Wednesday. So you'll be able to get those there also. But I've just put 2 slides in the front over here to explain the business more before I get into the numbers. So these orange blocks in the slide are really our key operating indicators. So our indicators that we measure on a weekly and a monthly basis, and for board reporting, to make sure we are heading in the right direction. And the green items are our product, as illustrated in the previous slide. I'll jump into the P&L, exactly how that is monetized and how that falls into our financial presentation. Our management fees for funds for the half year in 2026 was just over $2 million. That's a growth of 21% over the previous half year, and those are derived from our professionally managed accounts, InvestSMART, so the robo-advice solution, and the Intelligent Investor ASX listed active ETFs. In terms of the Intelligent Investor listed ETFs, there is no performance fee for this half year because one of the funds has a performance fee, but it is only crystallized at 30 June each year, so we aren't able to recognize that until 30 June each year. Subscription income is flat half year on half year. This is a harder revenue line to grow than funds under management. There's a lot of push and pull in this area, but it still remains a really vital part of our funnel for getting new people in to generate more funds under management. Commissions income and insurance relates to insurance policies that we have in a legacy book. We have reignited the ability to buy new life insurance premiums online, so we've got an aggregator for that, as well as reigniting the cash hubs. The reason that we didn't continue to pursue growing this revenue line item was primarily due to the Royal Commission in 2018, which recommended that life insurance commissions be reviewed by ASIC in 2023. And then around 2023, the Michelle Levy review came out, which has largely said that life insurance commissions are still fine. So we've decided that we're going to start promoting this service again shortly. We didn't want to do it after the Royal Commission because the risk of the government rescinding commissions again was just too high. Looking at the expenses, the commission rebates, those are just roughly 30% of whatever our insurance commissions are. These are rebates that go directly back to the client. Brokerage relates to us paying for brokerage for buy trades only in our professionally managed accounts. The largest line item in our expenses is employment expenses. So we've got 34 staff. So this is built for a highly scalable business. And that's augmented by artificial intelligence recently also. So we're looking to grow this business really, really big. And we think that the current staff that we have will adequately serve us for many years to come as we get into the billions of funds under management, apart from potentially in the sales and investor services team. So you probably add one or two people to every 200 or $300 million that you put on. Our marketing costs, we look at marketing from an opportunistic basis. As I said, our search engine optimization, which costs us very little, is our primary marketing method. And where we see other opportunities, we do look to dial those up, but at the moment it's relatively low. And then our other operating expenses was up 4% on the prior year. So it's important to note that these expenses are largely fixed. So there is fantastic P&L leverage in this business. At the moment, we're currently running at about break even, and we have cash at bank of $8.5 million at the end of December. So we've got a strong runway to continue to grow the business. Our FUM has grown by 25% over the last 5 years on a compounding annual growth basis. I'll just so on the stack bar chart, if we look at the first four bars, those are the intelligent investor active ETFs. We sort of think that the capacity of all of those is maybe $1 billion or so, although it might be more with international now, but there is a certain capacity with those. The real big opportunity for the long term is the dark blue bar over here, which is the portfolios of ETFs, which is theoretically unlimited, given that they are in ETFs that track underlying indices. Then the white bar over here is our white label product. That was recently launched. We're just leveraging our existing ecosystem to enable anyone with a digital audience to also be able to launch their own model portfolios, subject to quite a few guardrails. But we purposely seek out anybody that's also got a digital audience to allow them to distribute their own products through our platform. So the professionally managed accounts solution was established in November 2018, and it's a relatively unique solution in that the investor or the account holder holds legal and beneficial ownership, because the holdings that they hold are held on HIN through a broker. So it's not a custodial model where you have to explain to the end investor what a custodian is and then have a discussion about whether the custodian is going to be profitable or not, or solvent or not in the future. They're really held on HIN, so we don't have to have that discussion. It simplifies everything nicely. It has a low cost fee structure. We capped our management fee at 44 basis points, which is equivalent to $888 per annum on a $200,000 investment. We recently implemented an 11 basis points admin fee, and that is uncapped. So this, as I said earlier on, is our core growth engine for digital financial advice. It's got 6 diversified portfolios. So the 4 core ones being conservative, balanced growth, and high growth, and then single asset portfolios to solve for asset allocation where investors have already got a number of assets and need to balance those out. We also recently launched in July last year a custom portfolio. So this allows investors on the platform to hold an additional 5 ETFs to their portfolio from our approved product list. I'm sure you're not surprised to hear that the two most popular are silver and gold at the moment, but we think that just allows someone to add a little bit something different to suit their own objectives. These are the Intelligent Investor active ETFs. As I mentioned earlier on, ISV has a performance fee attached to it. Intelligent Investor follow a value investing approach and have done so rigorously since 2001. We started investing real money based on their model portfolios in July 2015, and we launched our first active ETF, which was INV, in 2018. Subscriptions. So there's been a bit of a decline in the number of subscriptions. I was talking about push and pull earlier on. We found that we're a little bit underpriced relative to our competitors. So we have increased the price per subscription in the last 2 years. And we allowed, so we did quite a big price increase in July 2025 of 20%. And we allowed subscribers to renew in advance. A large cohort did, which probably speaks to the quality of the publications. So we will only see those price increases flow through into the P&L over the next 2 years after that. So for the following sort of 18 months. So the performance of the InvestSMART portfolios. So these portfolios are created algorithmically based on the asset allocation that we see across the board in our peers, and because we have lower costs than our peers, we outperform those peer funds over time, and that is compounded by the differential in the fees over time. The Intelligent Investor fee performance is these three funds have outperformed their benchmarks up to 31 December 2025. So looking ahead at what we're focusing on. So we want to continue to grow our funds under management and subscriber base. We're constantly investing in our platform technology and efficiency, including utilization of artificial intelligence. We're currently looking at launching an SMS service. We're actually testing it at the moment, and we think that we know that we have a large cohort of SMSFs in our subscription and investor base, and we think that this is a complementary product, as well as those that come through the funnel from subscribers to investors. We're also looking closely at providing further tailored financial advice to high net worth clients. What that's really saying is that we're looking closely at a hybrid model. We've got 3 AFSLs, as I said earlier on. One of them is a responsible entity AFSL. We have another one which allows us to provide personal advice. We're going to continue to expand our brand reach and distribution. We've just recently launched some ETF awards. But it's important, whilst we continue to pedal hard to maintain financial discipline and flexibility, we do need to grow. We do need to continue to grow, but we can't do that at a high cost. When I say a high cost, I mean doing things like lots of outdoor advertising, so high costs of customer acquisition. We want to maintain our ability to grow where opportunities present themselves, and provide ourselves with a good runway. So our capital structure, our share price is quite low, and as you can see over there, our current market cap, excluding employee share options, is $11 million, whilst we have $8.5 million of cash at bank and $4.3 million in net tangible assets. So these employee options, they they a little bit more like options in reality, in that they only kick in from 14.5 cents up to 75 cents. And these are really important for aligning management and all staff with the company. And the majority of the shares are in the first 3 tranches. The first tranche was extended at the AGM in November 2025 out to November 2028. And that's it.
Thanks, Andrew. Just a couple of questions here. On the growth in funds under management, are you able to give a breakdown or a rough idea of, how much of that has come from fund flows, net fund flows versus, just like kind of growth in the market over the last, 3 years, 5 years, whatever time period?
Yeah, so I haven't published the gross flows. I know some asset managers do, but if we go to if you go to all the presentations, you'll be able to work it out based on growth in accounts. So this orange line here for professionally managed accounts is the growth in accounts. So you can see over here that we had some really strong growth up until when interest rates started increasing. I think everybody got really scared at that point in time and worried, and that flatlined for a while. And then from about June 24, we've started seeing people save through investment vehicles again. So that's the growth in number of accounts, which is a pretty good proxy. Yeah, I mean, you can tell from the intelligent investor funds what their growth in FUM is, and you'd be able to figure it out from there.
And on the white label offering, it's obviously the smallest of all in that like kind of bar chart that you had of the various products, but it is growing, ticking along quite nicely. I'm just wondering how you balance, bringing funds on board there where they've got a competing product either to your products or the intelligent investor products, as opposed to somebody coming to you where they can bring on products that are going to provide differentiation maybe to what is already there. So there's a bit of, it can get new products on there that you're not really interested in running or don't have the capacity to run, but on the other end there's the potential for kind of cannibalization over a kind of a product that's already on offer.
Yeah, no, good question. So we're quite particular about who we choose as partners for the white label offering. So first of all, they got to have digital distribution capabilities. So our current partners are Rask and Market Matters, and those guys offer a different digital presentation or a different style of newsletter to what we do existing with what we currently do. We like it if they're ETF centric also, and we enable them to sit within our ecosystem with all the guardrails that having a responsible entity has at the same time. So if we did see someone that was completely a very close match to an intelligent investor fund, for example, so single stocks, we probably wouldn't look at that from a white label perspective. But someone with a digital audience, ETF centric, different style of distribution, absolutely, that we would take them on as a partner. Yeah. And we don't think that cannibalizes our offering.
Yeah. And does it work on a revenue share model, or do you charge them kind of like a platform fee to run across your platform? How does it like technically, or
so we take a responsible entity. We'll take a responsible entity fee, and we'll pay the manager a management fee. Yeah.
Okay, perfect.
Yeah.
And I just wanted to touch on the insurance business for a second, because that has been in runoff for quite a number of years, and now with all the reviews being concluded, and you're going to turn it kind of back on again. And I know I'm just thinking back on memory here, it was it was over a $1 million a year revenue line at some point in InvestSMART's history, if I remember correctly. So, I mean, there's potential there to add quite a nice bit of revenue once you kind of turn the marketing and the sales function back on in that business. I mean, one, is that kind of a second half story, or will it be more a kind of an FY27 story? And kind of what's the goal in terms of trying to, get that business maybe back to the revenue generation line that previously was historically?
So, historically, that book was acquired out of Fairfax. InvestSMART was actually sold to Fairfax in 2007 and then sold out, and also as part of a business called YourShare, which was bought in 2014. So there were also funds management commissions in that book, and it was really a big revenue line item. I think between insurance and funds management in 2017 were probably about $8 million in revenue. So obviously the funds management commissions disappeared sort of overnight. Well, after the Royal Commission findings, and then we had until, but just get back to life insurance. So we didn't do a lot of distribution ourselves. That was primarily a cashback product. So what we've done is we've built the aggregator, and we're going to restart the cashback product also. And with distributing it, we're sort of testing. We've sent out one email already in the recent past. We're gonna slowly build those up and slowly build the presence up. I think it's important to note that insurance does really form a part of our vision, but our primary goal is to grow funds under management. So we really do want to grow that back up and have it really strong. But I think that it'll really start growing, as brand improves with growth in funds under management.
Yeah. And I mean, you're at 750 odd mil, let's call it now. I look at and they presented here before, and if you're in person with us, Brandon Malone from Raise, they're at just over $1 billion, but the market cap discrepancy between your funds under management versus them, and we've seen some transactions. I know Brendan has been vocal about it as well, in terms of what some of businesses with funds under management have sold for in your kind of I put say like fintech or non-traditional asset manager type businesses. Is there scope, because Raise have done 1 or 2 acquisitions, is there scope for you to pick up maybe 1 or 2 to accelerate that funds under management growth, given you have the responsibility, you have a lot of the infrastructure and operating knowledge kind of embedded in the business?
Yeah, absolutely. I mean, we're always open to talking to anyone in the industry, and if we're aligned, then that certainly helps. We like to remain and to be listed because we think that, as you've touched on, the company is worth X, and that currency will be very, very valuable at some point in the future. But at the moment, it is where it is. And if we can get that valuation back up to where we think it is, then that certainly is helpful also for anything else.
Andrew, thanks very much for joining us. It was great to get a good update on all things InvestSMART, and please pass on our regards to Ron there in the office. And we will leave it there for this morning. I'd like to thank all our presenters for joining us, and I wish everybody a good weekend. And please stay tuned. Next week we've got 9 companies presenting next week, 5 on Thursday, 4 on Friday. I look forward to seeing everybody then, and I wish everybody a good weekend. Thank you.